For financial reporting notes. Module 2, Presentation of Financial Statements. Part A, Presentation of Financial Statements 2.1, Complete Set of Financial Statements, p. 61. Components of a complete set of financial statements. Financial statements must provide the following information: assets, liabilities, equity, income and expenses, including gains and losses, contributions by and distributions to owners in their capacity as owners, cash flows. A complete set of financial statements contains EAS 1-para 10, a statement of financial position as at the end of the period, a statement of PL and SI for the period, a statement of changes in equity for the period, a statement of cash flows for the period. Notes, which include accounting policies and other explanatory information. Comparative information regarding the preceding period. A statement of the financial position as at the beginning of the earliest comparative period when any of the following occurs. An accounting policy is applied retrospectively. Items in the financial statements are retrospectively restated, or items in the financial statements are reclassified. The following set of Australian accounting standards. AS 101 Presentation of Financial Statements. AS 107 Statement of Cash Flows. AS 108 Accounting Policies. Changes in accounting estimates and errors. AS 1048 Interpretation on and Application of Standards. AS 1054 Australian Additional Disclosures, and AS 1057 Application of Australian Accounting Standards. The review by management may include a review of EAS 1-para 13, the main factors and influences determining an entity's financial performance, including changes in the environment in which the entity operates and how the entity is responding to those changes. Details about the entity's sources of funding and its targeted ratio of liabilities to equity. Details of the entity's resources not recognized in the financial statements. Furthermore, many entities also present environmental reports and value-added statements that are outside the financial statements. Reports and statements presented outside financial statements are outside the scope of IFS. EAS 1-para 14. Segment Reporting, p.63. IFS 8 requires an entity to disclose information that enables users of its financial statements to evaluate the nature and financial effects of the business activities that the entity engages in and the economic environments in which it operates. IFS 8-para 20. IFS 8 requires disclosure of the factors used to identify the entity's reportable segments, including the basis of organization, for example differences in products and services, geographical areas, regulatory environments, or some combination thereof. Judgments made by management if operating segments have been aggregated. Types of products and services that each reportable segment derives its revenues from. An operating segment is defined as a component of the entity that undertakes business activities from which it may generate revenues and incur expenses. Has its operating result regularly reviewed by the chief operating decision maker within the entity, such as the general manager, managing director or CEO. Has discrete financial information available. IFS 8-para 5. The focus in IFS 8, therefore, is to identify and report on operating segments effectively using the same basis as the internal decision maker. IFS 8 requires an entity to disclose the following financial information for each reportable segment. A measure of profit or loss. A measure of total assets and liabilities. Revenues from external customers. Revenues from transactions with transactions from other operating segments. Interest revenue. Interest expense. Depreciation and amortization. Material items of income and expense. The interest in the profit or loss of associates and joint ventures accounted for by the equity method. Income tax expense or income. Material non-cash items other than depreciation and amortization. IFS 8-para 23. Fair presentation and compliance with International Financial Reporting Standards, p.64. EAS 1 requires financial statements to present fairly the entity's financial performance, financial position and cash flows. EAS 1-para 15. The application of IFS, with additional disclosures where necessary, is presumed to result in financial statements that are fairly presented. EAS 1-para 15. EAS 1 requires entities with financial statements prepared in accordance with the IFS to make an explicit and unreserved statement of such compliance in the notes to the accounts. In order to make this statement, an entity must comply with all the requirements of IFS. EAS 1-para 16. An entity that departs from a requirement of an IFS must make the following disclosures. A statement that management believes the departure provides financial statements that present fairly the entity's financial position. Financial performance and cash flows. That except for departing from the requirements to achieve a fair presentation, it has complied with applicable ifs. The title of the ifs from which the entity has departed, the nature of the departure, including the treatment that the ifs requires and the treatment adopted, and the reasons why the ifs treatment would be misleading in the circumstances that it would conflict with the objective of the financial statements stated in the conceptual framework. The financial impact of the departure on each item in the financial statements that would have been reported in complying with the requirement is 1, para. 20. In the Australian context, the Corporations Act requires that the financial statements comply with accounting standards. S. 296. Also, if compliance with accounting standards does not provide a true and fair view, the Corporations Act requires an entity to provide additional disclosures necessary to give a true and fair view. S. 297. Going concern. P.65. A going concern is a business that is assumed will meet its financial obligations when they fall due. It functions without the threat of liquidation for the foreseeable future, which is usually regarded as at least the next 12 months or the specified accounting period. An entity shall prepare financial statements on a going concern basis unless management either intends to liquidate the entity, cease trading or has no realistic alternative. Is 1, para. 25. There is no specific requirement in Is 1 for the entity to disclose that it is considered a going concern, as it is an implicit assumption when preparing financial statements. However, where the entity is not considered a going concern, this must be disclosed together with the reasons why the entity is not considered a going concern and the basis on which the financial statements are prepared. If there are significant uncertainty as to the continuity of an entity's operations, but the financial statements are still prepared on a going concern basis, then details of the uncertainty must be disclosed. Is 1, para. 25. In assessing whether an entity is a going concern, management should consider all available information about the future, up until 12 months after the reporting period. Is 1, para. 26. Accrual bases. P.65. Is 1 requires that, except for cash flow information, financial statements be prepared under accrual accounting principles. Is 1, para. 27. The accrual basis of accounting provides users with richer information about the financial performance and financial position of an entity that would not otherwise be available if the cash basis were used. Under the accrual bases, items are recognized as assets, liabilities, equity, income and expenses when they satisfy the definitions and recognition criteria in the conceptual framework. Is 1, para. 28. Materiality and aggregation. P.65. The financial statements are derived after processing large numbers of transactions or other events that are aggregated into classes according to their nature or function. This process of aggregation and classification is necessary to determine the line items presented in the financial statements or notes to the financial statements. Is 1, para. 30. An entity shall present separately each material class of similar items. An entity shall present separately items of a dissimilar nature or function unless they are immaterial. Is 1, para. 29. Is 1 explains materiality in 3 parts. 1. Information is material if it could reasonably be expected to influence the primary users of financial statements' decision-making. 2. The nature or magnitude of information, or both, can influence materiality. Whether information, either individually or in combination with other information, is material in the context of its financial statements taken must be assessed by the entity. 3. Information is obscured if it is communicated in a way that has a similar effect to omitting or misstating that information. For example, vague language, incorrect classification and scattered information. Offsetting. P.66. Offsetting, or combining the balances, of assets and liabilities or income and expenses may result in the loss of relevant information for financial statement users. Unless it reflects economic substance, offsetting detracts from the ability of users to understand the transactions and other events and conditions that have occurred. Is 1, para. 33. Is 1 prohibits offsetting, except where it is required or permitted by an ifs. Is 1, para. 32. Example of permissible offsetting is ifs 15. Revenue from contracts with customers requires the amount of revenue recognized to be after any trade discounts and volume rebates the entity allows. Is 1, para. 34. Frequency of reporting. P.66. An entity must present a complete set of financial statements at least annually. Is 1, para. 36. If an entity changes the end of its reporting period, then it may present financial statements for a shorter or longer period than 12 months, but the change, and the reason for it, needs to be disclosed. Entities, for example retailers, may report using a 52-week period rather than annual period. Is 1, para. 37. Enhancing the inter-period comparability allows users of the financial statements to assess trends in financial information for predictive purposes. Here's 1. Para. 43. An entity must present comparative information regarding the preceding period for all amounts reported in the current period's financial statements, except when these permit or require otherwise. Here's 1. Para. 38. The requirement for comparative information means that an entity will, as a minimum, present 2 statements for each of the financial statements. Here's 1. Para. 38a. Here's 1 requires the presentation of a third statement of financial position as at the beginning of the preceding period if it applies an accounting policy retrospectively, makes a retrospective restatement of items in its financial statements or reclassifies items in its financial statements. The retrospective application, retrospective restatement or the reclassification has a material effect on the information in the statement of financial position at the beginning. Here's 1. Para. 40a. Where items in the financial statements are reclassified, the comparative amounts should also be reclassified, unless it is impracticable to do so. Here's 1. Para. 41. Where it is impracticable, the entity should disclose the reasons why and the nature of the adjustments that would have been made if the amounts had been reclassified. Here's 1. Para. 42. Consistency. P.67. Here's 1 requires that an entity should retain the presentation and classification items in the financial statements from one period to the next. The presentation and classification of items should only be changed when a significant change has occurred in an entity's operations, after reviewing the entity's financial statements. Management is of the opinion that a change in accounting policy is necessary to show a more appropriate presentation or classification, or a change is required by an ifs. Here's 1. Para. 45. A significant change on an entity's operations might arise following the disposal of a major line of its businesses. Here's 1. Para. 46. 2.2. Accounting policies. P.67. Selection of accounting policies. P. 68. Accounting policies are defined as the specific principles, bases, conventions, rules and practices applied by an entity in preparing and presenting financial statements. Here's 8. Para. 5. For example, whether to capitalize or expense borrowing costs, and whether to value non-current assets at cost or at fair value. Here's 8 requires management to select and apply accounting policies using a hierarchy. Accordingly, an accounting policy for a particular transaction, event or condition must comply with any relevant accounting standards and ESB interpretations. Where specific IFS requirements do not apply to a transaction, other event or condition, here's 8 requires management to use professional judgment and develop and apply accounting policies that result in information that is A. relevant to the economic decision-making needs of users, and B. reliable, in that the financial statements C. represent faithfully the financial position, financial performance and cash flows of the entity. D. reflect the economic substance of transactions, other events and conditions, and not merely the legal form. E. are neutral, for example free from bias. F. are prudent. And G. are complete in all material respects. Here's 8. Para. 10. Consistency of accounting policies. P.69. Consistency of accounting policies allows users to compare the financial statements of an entity over time to identify trends in financial position, financial performance and cash flows. Here's 8. Para. 15. Here's 8 requires that an entity must apply its accounting policies consistently for similar transactions, other events and conditions, unless an IFS specifically requires or allows the categorization of items for different accounting policies. Here's 8. Para. 13. For an example, here's 16. Property, plant and equipment allows different classes, or categories, of plant and equipment to be presented using a different measurement basis. Disclosure of accounting policies. P.69. Accounting policies adopted by an entity can significantly affect the way profits and financial position are reported, which influences economic decisions and other evaluations, including evaluations about the discharge of managerial accountability by users of those statements. Here's 1 requires that the notes to the financial statements present information about the specific accounting policies used in the preparation of the financial statements. Here's 1. Para. 112a. Here's 1 requires an entity to disclose its significant accounting policies comprising A. the measurement bases or bases used in preparing the financial statements, and B. the other accounting policies used that are relevant to an understanding of the financial statements. Here's 1. Para. 117. If alternatives are allowed under IFS, the disclosure of the accounting policy used is considered particularly useful. For example, measurement of plant at cost or fair value. Changes in accounting policies. P.70. Here's 8 permits an entity to change its accounting policies only if the change is required by an IFS, or results in the financial statements providing reliable and more relevant information about the effects of transactions, other events or conditions on the entity's financial position, financial performance or cash flows. IAS 8, para. 14. IAS 8 clarifies that the following are not changes in accounting policies. A. The application of an accounting policy for transactions, other events or conditions that differ in substance from those previously occurring. And B. The application of a new accounting policy for transactions, other events or conditions that did not occur previously or were immaterial. IAS 8, para. 16. Where an entity changes an accounting policy because of a new IFS, it must apply the transitional provisions in the IFS. IAS 8, para. 19. A. When there are no transitional provisions in the IFS, or the entity is making a voluntary change in accounting policy, the accounting policy change must be made retrospectively. IAS 8, para. 19. B. Retrospective application for voluntary changes in accounting policies ensures that the prior period comparatives are comparable to current period financial statements. These changes include: 1. The opening balance of each component of equity affected by the change must be adjusted for the earliest prior period presented in the financial statements. 2. The other comparative amounts disclosed for each prior period presented must be restated as if the new policy had always been applied by the entity. IAS 8, para. 22. IAS 8 recognizes that in some cases it may be impracticable to adjust comparative information for one or more prior periods. IAS 8, para. 23, and thus the new accounting policy must be applied from the earliest date practicable, which may be the current reporting period, and a corresponding adjustment must be made to each affected component of equity. IAS 8, para. 24. According to IAS 8, when the initial application of an IFS influences the current or prior period or potentially a future period, an entity must disclose the title of the IFS, the nature of the change in accounting policy for the current period and each prior period presented, the amount of the adjustment for each financial statement item affected and the impact on earnings per share disclosures if applicable. For periods before those presented, the amount of the adjustment to the extent practicable. When there are transitional provisions, disclose this fact together with a description of the transitional provisions and the effect they might have on future periods. If retrospective application is impracticable, the circumstance that led to the existence of that condition, and a description of how and when the change in accounting policy has been applied. IAS 8, para. 28. According to IAS 8, when an entity makes a voluntary change in accounting policy that influences the current or prior period or potentially a future reporting period, the entity must disclose the nature of the change in accounting policy, the reasons why the change provides reliable and more relevant information, the amount of adjustment for each financial statement item affected, current and prior period, and the impact on earnings per share disclosures if applicable, the amount of the adjustments relating to periods before those presented to the extent practicable. Advise that retrospective application is impracticable for a particular prior period or for periods before those presented, the circumstance that led to the existence of that condition and a description of how and from when the change has been applied. IAS 8, para. 29. 2.3. Revision of accounting estimates and correction of errors. P.72. Changes in accounting estimates. P. 72. Uncertainties inherent in business activities means that many items included in financial statements involve measurements that require estimations. Examples of estimates include bad debts, inventory obsolescence, the fair value of financial assets and liabilities, the useful lives of depreciable assets and warranty obligations. IAS 8, para. 32. According to IAS 8, a change of accounting estimate must be recognized prospectively by including it in the profit or loss in the period of the change, the current period, if the change affects that period only, the period of the change and future periods, if the change affects both. IAS 8, para. 36. The IAS 8 requirements in relation to changes in estimates operate as follows. Income and expense adjustments as a result of the revision must be recognized in either the current reporting period or the current and future reporting periods, depending on which periods the change of estimate affects. IAS 8, para. 36. Where relevant, adjustments to assets, liabilities and equity items should be made in the reporting period of the change of estimate. IAS 8, para. 37. Specific disclosures must be made of the nature and amount of the revision in the accounting estimate where the change affects the current reporting period and, to the extent it is practicable, disclosure of the effect on future reporting periods. IAS 8, para. 39. Material errors in prior period. P.73. Financial statements are considered not to comply with the accounting standards if they contain either material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position. Financial performance or cash flows. EARS 8, para. 41. When material errors are discovered in a reporting period subsequent to the reporting period S in which the error occurred. EARS 8 requires retrospective correction of the error in the first set of financial statements issued after the error's discovery. As with changes to accounting policies, EARS 8 requires that a catch-up adjustment be made starting from the date that the error was made. If this error relates to the profit or loss of a period not covered by the financial statements, then the adjustment is made to that opening balance of retained earnings. Finally, where a prior period error has been corrected in a reporting period, EARS 8 specifies disclosure of information including a. the nature of the prior period error, b. for each prior period presented, to the extent practicable, the amount of the correction, I. for each financial statement line item affected, and 2. If EARS 33 earnings per share applies to the entity, for basic and diluted EPS, c. the amount of the correction at the beginning of the earliest prior period presented, and d. if retrospective restatement is impracticable for a prior period. The circumstances that led to the existence of that condition and a description of how and from when the error has been corrected. EARS 8, para. 49. 2.4 Events after the reporting period. P.75. The objective of EARS 10 is to prescribe when an entity should adjust its financial statements for events occurring after the reporting period and the disclosures it should give about such events in the notes to the financial statements. EARS 10, para. 1. An event after the reporting period, or a subsequent event, is defined as a favorable or unfavorable event occurring between the end of the reporting period and the date when the financial statements have been authorized for issue. EARS 10, para. 3. The date of authorization is important, because events after this date do not qualify as events after the reporting period. In the case of the company, the date of authorization is usually the date the directors sign a director's declaration that is attached to the financial report. If an event occurs after the directors have signed off, then EARS 10 does not apply, and the event will be recognized in the next reporting period. 2 types of events after the reporting period. P.75. 1. Those events that provide new or further evidence of conditions that existed at the end of the reporting period called an adjusting event. EARS 10, para. 8. 2. Those events that reflect conditions that were applicable at the end of the reporting period, but which arose for the first time after the end period called a non-adjusting event. EARS 10, para. 3. Adjusting events. P.76. An adjusting event is one that provides new or further evidence of conditions that existed at the end of the reporting period. An adjusting event may provide additional information about items that existed at the end of the reporting period, but for which the amount was uncertain and had to be estimated. The additional information after the reporting period informs what the correct amount is for the financial statements. And examples of adjusting events would be a court case that was in existence, but had not been settled by the end of the reporting period, subsequently decided after the reporting period, where the outcome is now known. If the new information relates to items presented in the financial statements, then this means posting a journal entry to adjust the amounts recognized in the financial statements. If the new information concerns information disclosed in the notes to the financial statements, then this means making changes to the note disclosures. Non-adjusting events. P.76. A non-adjusting event is information that does not relate to a condition that existed at the end of the reporting period. An example of a non-adjusting event is a major business combination change after the reporting period, for example acquisition or disposal of a subsidiary. In the case of non-adjusting events after the reporting period that are material, an entity should disclose in the notes to the financial statements the nature of the event and an estimate of its financial effect, or a statement that such an estimate cannot be made. EARS 10, para. 21. Dividends declared after reporting period. P.78. EARS 10 requires that an entity should not recognize those dividends as a liability at the end of the reporting period, even if the dividend was declared from profits derived prior to the end of the reporting period. EARS 10, para. 12. This is because such dividends failed the essential characteristic of a liability, that is, a present obligation existing at the end of the reporting period. EARS 10, para. 13. As such, the dividends declared payable shall be regarded as a non-adjusting event and be disclosed in the notes to the financial statements. Going concern issues after reporting period. P.78. EARS 10 does not permit an entity to prepare its financial statements on a going concern basis if management determines after the reporting period that it either intends to liquidate the entity or cease trading or has no realistic alternative but to do so. EARS 10, para. 14. EARS 10 effectively treats the new information regarding going concern as an adjusting event, and thus the financial statements would have to be presented on the basis that the entity is not a going concern, for example, using liquidation values. 2.5. The impacts of technological advancements on the presentation of financial statements. P.79. It is common practice for financial statements to be released 3 months after the end of the reporting period, and thus even more work is needed to identify and recognize the effects of adjusting and non-adjusting events to somehow still maintain reasonable timeliness of information disclosed. This practice and the need to disclose events after the reporting period will change soon as technological advancements allow entities to prepare financial reports instantaneously through powerful cloud-based management applications that can automatically generate reports that combine an entity's structured financial data with narrative analysis. Those reports are not only prepared faster but can be updated automatically as new events occur. They can also be subject to less human errors as human intervention is kept at a minimum. Part B. Statement of Profit or Loss and Other Comprehensive Income. P.82. 2.6. Presentation of Comprehensive Income. P.82. IAS 1 requires an entity to present either 1. A single statement of profit or loss and other comprehensive income with 2 sections presented together, the first section for the profit or loss followed by the second section for other comprehensive income, or 2 statements, a separate statement of profit or loss presenting components of profit or loss, which must be immediately followed by a separate statement presenting comprehensive income, beginning with the profit or loss and presenting components of other comprehensive income. IAS 1, para. 10a. 2.7. The concept of other comprehensive income and total comprehensive income. P.83. Other comprehensive income comprises items of income and expense, including reclassification adjustments that are not recognized in the profit or loss as required or permitted by IFRS. SI equals total comprehensive income, profit loss for the period. Total comprehensive income equals profit loss plus SI. IAS 1 states that the components of other comprehensive income include gains and losses recognized in the revaluation surplus resulting from the revaluation of property, plant and equipment under IAS 16 or intangible assets under IAS 38. Gains and losses from remeasurements of defined benefit plans under IAS 19. Gains and losses arising from translating the financial statements of a foreign operation under IAS 21. Gains and losses from investments in equity instruments designated as fair value through a SI under IFRS 9. Gains and losses on other financial assets measured at fair value through a SI under IFRS 9. Gains and losses on hedging instruments in a cash flow hedging gains and losses on hedging instruments for investments in equity instruments measured at fair value through a SI under IFRS 9. Changes in the value of the time value of options for certain option contracts designated as hedging instruments under IFRS 9. IAS 1, para. 7. An entity recognizes items outside the profit or loss of the current period in the following circumstances: the correction of errors or changes in accounting policies in accordance with IAS 8. Other IFRS require or permit items of income or expense to be excluded from profit or loss even if it meets the conceptual framework definition of income or expense. IAS 1, para. 89. Contributions by that owners, for example issue of new shares, and reductions in equity, for example share buybacks and dividends, are recognized directly in the cash flow statement whilst everything else is reflected in the statement of PL and SI. 2.8. IAS 1 Disclosures and Classification. P.84. IAS 1 allows an entity to either present 1. A single statement of PL and SI, or 2 statements, for example a separate statement of PL and a separate statement of comprehensive income. IAS 1, para. 10a. Single statement of PL and SI. P.84. In addition to a section for the PL and a section for SI, the statement of PL and SI must present the profit or loss. Para. 81a. A. Total other comprehensive income. Para. 81a. B. Comprehensive income for the period, being the total of profit or loss and other comprehensive income. Para. 81a. C. 2 statements, statement of profit or loss and a statement of comprehensive income. P.85. The main difference between the single statement approach and the 2-statement approach is that instead of showing both sections in one combined statement, there are 2 separate statements. In the 2-statement approach, the statement of PL includes the entity's incomes and expenses for the period ending with the line profit or loss for the period. The statement of comprehensive income commences with the line item for the profit or loss and then adds the SI items. IAS 1 prohibits the presentation of extraordinary items in the statement S, presenting profit or loss and other comprehensive income or in the notes. IAS 1, para. 87, for example major asset write-downs. Information presented with profit or loss. P.85. The required line items must be shown separately and are listed in paragraph 82 of IAS 1 as revenue, presenting separately, interest revenue calculated using the effective interest method, and 2. Insurance revenue, see IFRS 17. A. Gains and losses arising from the derecognition of financial assets measured at amortized cost. B. Insurance service expenses from contracts issued within the scope of IF 17, see IF 17. C. Income or expenses from reinsurance contracts held, see IF 17. Finance costs. A. Impairment losses, including reversals of impairment losses or impairment gains, determined in accordance with Section 5 of IF 9. B. Insurance finance income or expenses from contracts issued within the scope of IF 17. C. Finance income or expenses from reinsurance contracts held, see IF 17. Share of the profit or loss of associates and joint ventures accounted for using the equity method. A. If a financial asset is reclassified out of the amortized cost measurement category so that it is measured at fair value through the profit or loss. Any gain or loss arising from a difference between the previous amortized cost of the financial asset and its fair value at the reclassification date, as defined in IF 9. B. If a financial asset is reclassified out of the fair value through other comprehensive income measurement category so that it is measured at fair value through the profit or loss. Any cumulative gain or loss previously recognized in other comprehensive income that is reclassified to profit or loss. C. Tax expense. A single amount for the total of discontinued operations, see IF 5. Expenses, nature or function. P.86. The choice between classification of expenses by nature or function is made based on whichever system provides information that is reliable and more relevant. Here's 1, para. 99. In effect, classification by nature means expenses are presented descriptively what they are, whereas classification by function means expenses are presented purposively what role they have to the entity's operations. An example of classification of expenses by nature includes changes in inventories of finished goods and work in process, raw materials and consumables used, employee benefits expense, depreciation and amortization expense. Here's 1, para. 102. An example of classification of expenses by function includes cost of sales, distribution expenses and administration expenses. Here's 1, para. 103. The choice between nature and function is a matter of professional judgment and will depend on several factors, including the nature of the entity and industry factors. Here's 1, para. 105. When expenses are classified by function, the entity must disclose, in the notes, information about the nature of expenses, including depreciation and amortization expense and employee benefits expense. Here's 1, para. 104. Separate disclosure of material income and expense items. P.87. Here's 1 also requires an entity to separately disclose the nature and amounts of items of income and expense that are material based on professional judgment. Here's 1, para. 97. This additional level of disclosure assists financial report users to fully understand the financial performance of an entity. Examples of separate disclosures of material items of income and expense include write-downs of inventories to net realizable value, write-downs of PPE to recoverable amount or reversals, restructurings of the activities of an entity and reversals of any provisions, disposals of PPE and investments, discontinued operations and litigation settlements. Information presented with other comprehensive income. P.87. Here's 1 requires the applicable financial statement to present amounts for line items of other comprehensive income for the period as items of SI classified by nature grouped into those where the items are subsequently reclassified to the profit or loss and those that are not. The share of SI of associates and joint ventures accounted for using the equity method, separated into those where the share of items is subsequently reclassified to the profit or loss and those that are not. Here's 1, para. 82a. First, the nature and amount of each item of SI must be presented separately, including the share of SI of equity accounted associates and joint ventures. Second, the items must be grouped into those that will be reclassified subsequently to profit or loss when specific conditions are met and those that will not. Whether an item of SI may be classified subsequently to the profit or loss is determined by the ifs relevant to that item. For example, translation of the financial statements of a foreign operation. When the foreign operation is held, the translation gains losses are recognized in SI and accumulated in equity in A. Foreign currency translation reserve. When the foreign operation is disposed of, ES 21 requires the cumulative amount of exchange differences to be reclassified from equity SI to the profit or loss. ES 21, para. 48. ES 1 requires an entity to disclose the amount of income tax relating to each item of comprehensive income either in the applicable financial statement or in the notes to the financial statements. ES 1, para. 90. Items of other comprehensive income may be presented net of related tax or gross, before tax, with an aggregate amount of tax disclosed for the SI items in total. Here's 1, para. 91. When the before tax approach is used, an entity will disclose the income tax relating to each item of SI in the notes to the financial statements. In the financial statement, However, income tax must be allocated between the two groupings of SI, that is, between those items that will be subsequently reclassified to the profit or loss and those items that will not. When the net of tax approach is used, the amount of income tax relating to each item of SI may be disclosed either in the financial statement or in the notes to the financial statement. What happens to the totals in the statement of profit or loss and other comprehensive income? P.88. Both the net profit after income tax figure and the other comprehensive income figures are transferred to the statement of changes in equity. 2.9. Tips on how to analyze the statement of profit or loss and other comprehensive income. P.89. 1. Review the components of income. Has there been an increase or decrease in total revenue from the previous reporting period? What are the main drivers for this increase or decrease? Refer to the notes to the accounts for further information about income. 2. Review the components of expenses. How does the entity classify its expenses, by nature or function? Has there been an increase or decrease in expenses from the previous reporting period? What are the main drivers for this increase or decrease? Are there any notable large movements, or any one-off material, non-recurring expenses, such as impairment losses? Refer to the notes to the accounts for further information about expenses. 3. Review the profit result for the period. Has the entity made a profit or a loss? How does this result compare to the previous reporting period? What are the main drivers for the increase or decrease in profit? 4. Review the SI result. Are there any significant changes in items of comprehensive income, e.g., asset revaluations, from the previous reporting period? What are the main drivers for these changes? 5. Overall performance. In your opinion, how well is the company performing? Did it perform better or worse than the previous reporting period? Part C, Statement of Changes in Equity 2.10. Here's 1 Presentation of Financial Statements. Disclosures of Changes in Equity, P.91. A statement of changes in equity explains and reconciles the movement in the equity net assets of an entity over a reporting period. The two primary sources of change in owners' equity and therefore net assets are 1. Changes resulting from transactions with owners in their capacity as owners. 2. The total amount of income and expenses generated by entities' activities. Here's 1, para. 109. Here's 1 requires an entity to present a statement of changes in equity, with the following disclosures. Total comprehensive income allocated between non-controlling interests and owners of the parent, para. 106. A. The effect on each component of equity of any retrospective adjustments required by IAS 8, para. 106. B. A reconciliation between the opening and closing balance of each component of equity, with separate disclosure of changes resulting from profit or loss, assigned transactions with owners, para. 106. D. Revaluation of assets liabilities must be included in changes to equity. Part D. Statement of Financial Position, p. 94. 2.11. Format of the Statement of Financial Position, Balance Sheet, p. 94. Here's 1 prescribes the balance sheet to include presentation requirements for assets and liabilities, disclosure requirements for a statement of financial position and its components. Here's 1 does not stipulate a strict format for the statement of financial position, but it does stipulate the minimum disclosures for the line items that are included in the statement. Here's 1, para. 54. An entity makes the judgment about whether to present additional line items based on the nature and liquidity of assets, function of assets within the entity, amount, nature and timing of liabilities. Here's 1, para. 58. The number of shares authorized, issued and fully paid does not have to be included in BS whilst investments accounted for using the equity method do have to be included. 2.12. Presentation of assets and liabilities, p.95. An entity must present current and non-current assets and current and non-current liabilities as separate classifications in the statement of financial position except if a presentation based on liquidity provides information that is reliable and more relevant. When the liquidity basis is applied, assets and liabilities must be presented in the order of liquidity. For example, cash deposits would be presented before plant and equipment. Here's, para. 60. When an entity supplies goods and services within a clearly identifiable operating cycle, the current and non-current classification system provides information that is reliable and more relevant because it distinguishes between assets and liabilities circulating as working capital from those held for long-term operations. Here's 1, para. 62. In contrast, financial institutions use the liquidity basis of presentation because the solvency of such institutions is critical, and they do not provide services within an operating cycle. Here's 1, para. 63. If an entity has an asset or liability line item that combines amounts due to be recovered or settled both within and after 12 months of the reporting period, it must disclose the amount expected to be recovered or settled after 12 months. Here's 1. Para. 61. Current assets and current liabilities. P.95. An entity must classify an asset as current when it satisfies one or more of the following criteria. It expects to realize the asset, or intends to sell or consume it, in the entity's normal operating cycle. It holds the asset primarily for trading purposes. It expects to realize the asset within 12 months after the reporting period. The asset is cash or a cash equivalent. Here's 7. Unless the asset is restricted from being exchanged or used by the entity for at least 12 months after the period. Here's 1. Para. 66. Examples of current assets include cash and cash equivalents, inventories, trade receivables, current tax receivable, and prepayments. Examples of non-current assets include property, plant and equipment, intangibles, investments and deferred tax. An entity must classify a liability as current when it satisfies one or more of the following criteria. It expects to settle the liability in the entity's normal operating cycle. It holds the liability primarily for trading purposes. The liability is due to be settled within 12 months after the reporting period. It does not have an unconditional right of deferring settlement beyond 12 months after the reporting period. Here's 1. Para. 69. All assets not classified as current are to be classified as non-current assets. Current liabilities include those liabilities that are required or expected to be settled within 12 months after the end of the reporting period. Examples of current liabilities include a bank overdraft, trade payables, accruals for operating costs like electricity and rent, and accruals for employee wages. Liabilities that do not satisfy the criteria to be classified as current must be classified as non-current liabilities. Here's 1. Para. 69. Financial liabilities that provide financing on a long-term basis that are not due for repayment within 12 months of the reporting period are non-current liabilities unless there are unresolved breaches of covenants at the end of the reporting period. Here's 1. Para. 71. 2.13. Here's 1. Presentation of financial statements. Disclosures in the notes to the Statement of Financial Position. P. 96. The disclosure of further subclassifications depend on the size, nature and function of the amounts involved and are usually presented in the notes. Here's 1. Provides examples of further subclassifications as items of property, plant and equipment disaggregated into classes pursuant to as 16 such as office equipment and motor vehicles. Para. 78a. Receivables disaggregated into amount due from trade customers, related parties, prepayments and other amounts. Para. 78b. Inventories disaggregated pursuant to as to into finished goods, work in process and raw materials. Para. 78c. Provisions disaggregated into provisions for employee benefits and other provisions. Para. 78d. Equity capital and reserves disaggregated into paid up capital, retained earnings and other reserves. Para. 78e. 1. Review the value of total assets. Have total assets increased or decreased from the previous reporting period? What are the drivers behind this increase or decrease? If total assets are increasing, this indicates that the financial position has expanded, grown. Has the change been primarily as a result of changes in current assets or non-current assets? 2. Review the value of total liabilities. Have total liabilities increased or decreased from the previous reporting? What are the drivers behind this increase or decrease? If total liabilities are increasing, this indicates that the entity has taken on more debt and has increased its gearing, leverage. Has the change been primarily as a result of changes in current liabilities or non-current liabilities? 3. Review the value of total equity or net assets. Is total equity positive? If so, this indicates that the company is a going concern. Has total equity increased from the previous reporting period? If so, this indicates that the entity's financial position has grown. The stage of the business life cycle will also impact on this figure. More mature businesses are likely to have greater amount of retained earnings, whereas startups may experience losses in the first years of trading. 4. Analyze the relationship between current assets and current liabilities. This is an indication of the company's liquidity position or the entity's ability to be able to pay its short-term debts as and when they fall. Are current assets greater than current liabilities? The general rule of thumb for the current ratio is 2:1. This means that ideally current assets should be approximately 2 times larger than current liabilities. Part E. Here's 7 Statement of Cash Flows. P.99. 2.15. How does a statement of cash flows assist users of financial statements? P. 99. In ES7, the information provided in a statement of cash flows may assist users to understand generate cash flows in the future, meet its financial commitments as they fall due, including the servicing of borrowings and payment of dividends, fund changes in the scope and or nature of its activities, obtain external finance, EAS 7, PARAs 4 and 5. It has also been suggested that a statement of cash flows is useful for predicting future cash flows, both inflows and outflows, evaluating management decisions, determining the ability to pay dividends to shareholders and repay debt, both interest and principal, to creditors, showing the relationship of net profit to changes in the cash balances, assessing the quality of revenue and earnings by reference to its realization in cash. 2.16 Information to be disclosed, P.100. Cash and cash equivalents, P.100. According to EAS 7, cash and cash equivalents are determined as cash comprises cash on hand and demand deposits. Cash equivalents are short-term, liquid investments that are readily convertible to amounts of cash and which are subject to insignificant risk of changes in value. EAS 7, para. 6. An investment normally only qualifies as a cash equivalent if it has a short maturity of 3 months or less from the date of acquisition, and investments in equity securities do not qualify. EAS 7, para. 7. Bank overdrafts which are repayable on demand and fluctuate from being positive to overdrawn are included as a component of cash and cash equivalents. EAS 7, para. 8. Classification of cash flows, P.100. The statement of cash flows must report cash flows during the period, both inflows and outflows, classified by operating, investing and financing activities. EAS 7, para. 10. Cash flows from operating activities are those that relate to the principal revenue-producing activities of the entity and which are not from investing or financing activities. EAS 7, para. 6. An entity must report cash flows from operating activities using either the 1. Direct method, in which major classes of gross cash receipts and gross cash payments are disclosed. 2. Indirect method, whereby profit or loss is adjusted for the effects of non-cash income and expenses, accruals and items for investing and financing activities. EAS 7, para. 18. Consistent with EAS 7, this module recognizes interest paid, borrowing costs, as an operating cash outflow, interest received as investing cash inflow, and dividends paid as a financing cash outflow. Investing cash flows, P.101. Cash flows from investing activities are those that relate to the acquisition and disposal of long-term assets and other investments not included in cash and cash equivalents of the entity. EAS 7, para. 6. Most investing cash inflows and outflows are identified by analyzing the movements in the non-current assets accounts in the statement of financial position. Financing cash flows, P.102. Cash flows from financing activities are those that result in changes in the size and composition of the contributed equity and borrowings of the entity. EAS 7, para. 6. Financing cash flows relate to the providers of capital to the entity, that is, debt holders and equity participants. EAS 7, para. 17. 2.17 Common methods adopted on how to prepare a statement of cash flows, P.102. There are 3 common methods used to prepare a statement of cash flows, which include 1. Worksheet method, typically prepared in a spreadsheet tool such as Excel. 2. Formula method. 3. Account reconstruction method. Formula method, P.103. Reporting cash flows on a net basis, P.104. Normally, cash flows are reported on a gross basis. However, reporting cash flows on a net basis is permitted in limited circumstances. EAS 7 allows cash flows to be reported on a net basis as A. Cash receipts and payments on behalf of customers, when the cash flows reflect the activities of the customer rather than those of the entity. And B. Cash receipts and payments for items in which the turnover is quick, the amounts are large, and the maturities are short. EAS 7, para. 22. Example of cash receipts and payments on behalf of customers include rents collected by an agent on behalf of the owners of the properties. EAS 7, para. 23. Examples of cash receipts and payments for items with quick turnover and short maturity are principal amounts relating to credit card customers. EAS 7, para. 23a. Other information to be disclosed in the statement of cash flow or notes, P.104. These cash flow items include interest and dividends, income taxes and loss of control of subsidiaries. EAS 7, paras 31, 35, 39 and 40. An entity must also disclose the amount of significant cash and cash equivalent balances held that are not available for use by the group. IAS 7, para.48. For example, there may be exchange controls or legal restrictions in place that restrict the movement of cash. IAS 7, para. 49, and this disclosure is important as it allows users to make informed decisions regarding the liquidity of an entity. Another disclosure that is encouraged is the amount of undrawn borrowing facilities that may be available for the future cash needs. Here's 7, para. 50. Consolidated financial statements, P.105. A parent entity in a group that is required to prepare a set of consolidated financial statements will include a statement of cash flows that discloses the cash flows of the group. However, please note that consolidated cash flows should be reported net of cash flows among entities comprising the group. Foreign currency translation is required when a foreign subsidiary is a member of a domestic group, and a consolidated statement of cash flows is to be prepared. 2.18 Tips on how to analyze the statement of cash flows, P.105. 1. Review the cash balance at the end of the reporting period. Is this value positive? Is it greater than or less than the balance at the beginning of the reporting period? 2. Review the cash flows from operating activities. This figure is essentially the entity's cash profit figure. Is this value positive? A positive value is a good sign that the entity has made a cash profit during the reporting period. How does this value compare to the previous reporting period's cash flows from operating activities? If the result for the current period is higher, this is a good sign as it indicates that the entity's cash profit has increased. If the cash profit figure has decreased, this would firstly indicate that the entity has a cash loss during the current reporting period. The entity has spent more money on its operating day-to-day activities than it has received. This is a less positive sign, as all entities should be looking to make an underlying cash profit from their day-to-day business operations. As a rule of thumb, the entity should report a positive cash flow from operating expenses, and this amount should, in principle, be enough to cover net cash used in investing and financing activities. 3. Review the cash flows from investing activities, i.e., purchasing and disposing of non-current assets and investments. Is this value positive or negative? If negative, this indicates that the entity has invested in non-current assets. This could mean that the entity is expanding its operations, or that the entity may be in the startup or growth phase of the business life cycle. 4. Review the cash flows from financing activities, that is the business funding the acquisition of assets through debt or equity? Review the increases or decreases in external borrowings. Has the entity borrowed or paid back funds? Review the increases and decreases in equity. Has the entity paid dividends or issued more shares to raise capital? How does the payout of dividends compare to the net cash flow from operating activities? Has the entity paid out a high percentage of profits to its shareholders, or has it retained the funds to cover operating costs and repayment of financing arrangements? 5. Review the net increase or decrease in cash and cash equivalents. Is this value positive or negative? A positive value indicates that the entity has retained and banked funds for the reporting period. This also indicates that the entity has generated substantial cash profits from operating activities. This will be particularly pleasing for shareholders who are interested in the ability of their investment to generate positive returns.